Welcome to the Explainer. So, what if I told you that the main reason most traders lose money isn't their strategy or their discipline, but the very tool they stare at all day, every day? We're about to break down a radical argument that might completely change how you look at financial charts forever.
Let's just kick things off with a question that I think haunts the entire trading world. I mean, with all the tech we have, all the analysis, the endless books and courses, why do so many people, the vast majority in fact, still struggle to be consistently profitable?
Well, the source we're digging into today makes a really bold claim. It says the answer isn't some secret new indicator or a complex strategy. Nope, it's that the tool everyone relies on, the chart itself, is fundamentally broken. The reason for failure, it says, is literally hiding in plain sight.
All right, so let's get into it. To really understand this argument, we first have to break down the standard financial chart. You know, the one we all know so well.
At its very core, it's a super simple setup, right? You've got price going up and down on the vertical axis, and you've got time moving left to right on the horizontal one. Every single point on that graph is just telling you one thing: what the price was and when it was that price. Simple.
Okay, but with that simple picture in mind, let's ask the million-dollar question. Literally, if you're a trader looking at this chart, where's the money? Where is the actual profit that you're trying to capture?
Well, think about it like this. If you draw a line straight down from the current price, from this exact moment, you split the chart into three zones. Everything to the left, that's the past. It's already happened. And everything to the right, well, that's the future. It hasn't happened yet.
And here's the kicker. You can't make money on what happened yesterday. That ship has sailed. And you can't really make money in the blink of an eye present moment either. By definition, profit can only come from what the price does next. It exists exclusively in that zone to the right of the line, the future.
And this is where we get to the absolute core of the argument, because this is where the whole idea of the conventional chart starts to just completely fall apart. So, let's focus all our attention on that future area of the chart, you know, the only place where profit can even exist, and let's ask a simple question. What factual price data do we actually have in that space?
The answer? Absolutely nothing. Zip. Nada. By its very definition, the future area on a chart that's based on time has zero data. It's a complete information void. How could it have data? It hasn't happened yet.
And according to our source, this right here is the fatal flaw. We think we're making these smart, informed, data-driven decisions, but we're making them about an area on the chart where no data exists. It basically forces every trade to be a bet, just a guess about what might show up to fill that empty space.
So let's just sum up the big problems here. First, the only place you can make money is a data-free zone. Second, the patterns are fractal. A 1-minute chart looks suspiciously like a 1-month chart, which can really mess with your perception of risk and scale. And finally, the argument goes that its main practical use ends up being just a historical receipt to prove to your broker, yep, that's where I lost the money. Ouch.
Okay, so if the time axis is the villain in this story, creating this massive information blind spot, what's the solution? Well, the one proposed as radical as it is dead simple. The logic is actually pretty straightforward. Just get rid of the thing that's causing the problem. By completely removing the time axis, you eliminate that big, blank, unknowable future space from your analysis altogether.
But what are you left with? I mean, if you take away time, what are you even looking at? The answer is you get a totally different kind of tool. It's not a timeline anymore, it's a map.
So instead of plotting price versus time, you plot price versus another price. This creates something called a relational chart. For instance, you could put the US dollar versus the Japanese yen on the bottom axis, and the euro versus the Japanese yen on the side axis. Now, every single point on that chart represents a live, current relationship between those two things. The chart stops being a history book and becomes a map of the present.
And when you put them side by side, the difference is just night and day. The old time-based chart is a road that leads directly into an information black hole. The relational chart, though, it's a map. From your current position, there's real, live data in every direction, up, down, left, and right, because it's all based on what's happening right now.
And this is the whole game changer. You are no longer staring into a void, guessing about the future. You're analyzing a field of current possibilities. And get this, if a trade goes wrong, you can actually look at the map of other relationships to understand why. It gives you this panoramic 360-degree view of the market, not just one asset's lonely walk off a cliff. So ultimately, this whole idea leaves us with a pretty provocative question to chew on. It's not about throwing your old charts in the trash. It's about questioning what they really show you. So ask yourself, is the time on your chart actually helping you predict the future? Or is it just creating a massive blind spot right where the money is supposed to be?